In this second video on cash flow and financial planning, let's talk about some of the particulars about how we analyze cash flows and how we can use some of this data and how it's ultimately calculated. So cash flow, as opposed to profits, right, is the primary ingredient we have in any financial valuation model. And we've talked about this many times. Cash flow is the number that we want. So from an accounting perspective, cash flow comes from the firm's statement of cash flows. From a financial perspective, we want to focus on a couple of things. The first number we want to look at is something called the operating cash flow. This is what's used in managerial decision making, right? This is the number managers use to understand how much cash they're generating towards the company's operations. Free cash flow is a number that's more closely monitored by the participants in the marketplace. So this is the number that investors want. So there are two numbers as we work our way through here that we ultimately want to be able to calculate and determine. So depreciation, and what are referred to generally as non-cash expenses, depreciation is the thing that generates this cash flow difference from profitability, right? So for tax purposes, we use something called MACRS. It's the Modified Accelerated Cost Recovery System. On the other hand, right, if you're just doing this for financial statements, typically we'll just use some simpler model like straight line. So there are a variety of depreciation methods that are used depending on the purpose of the information. The value of an asset, the thing that we get to depreciate, is referred to as its depreciable value or its basis. It's the cost of the asset plus any installation costs. And so this is all the costs of getting this asset producing revenues for the company. So here we have a company. They acquired a new machine, cost $90,000. It's going to install $12,000. When this machine's retired from service, they're going to be able to sell it for scrap metal, and they'll be able to receive $5,000 for this when it has lived out its usefulness. So what is the depreciable value of this machine if we assume a 5-year depreciable life? Well, regardless of a salvage value, again, we don't need that for this question. It's just the cost of the asset plus the $12,000 installation cost. So we'd be able to depreciate this asset over the 5-year depreciable life, and we'd be able to depreciate it $102,000. Now, what the IRS has done for us is they've categorized all assets by their depreciable life. So if we were looking at, a pickup truck, right? Where would a pickup truck go? Well, here we have a category for light duty trucks and cars, right? Computers. These things are typically depreciated over 5 years, right? If you have equipment for petroleum refining, right, you can depreciate that over 10 years. So we do have some help from the IRS to understand what the depreciable life of the asset is. Going with that, there also is a table then that we can understand, or where we can get the depreciation expense on an annual basis. So if you have an asset that's a 3-year asset, the very first year you can depreciate its value, its basis, by 33%. So you just take 33%, multiply that by the depreciable basis. That's the depreciation you take in year 1. Now what I want you to pay close attention to is A 3-year asset is depreciated over 4 years. A 5-year asset is depreciated over 6 years. This extra year is a half year. So this first year, it's really only a half year's depreciation. This last year is the last year. So we have a half year, full year, that's 1.5, that's 2.5, that's 3.5 years worth of depreciation. So don't get fooled by thinking that a 3-year asset's only depreciated for 3 years. It's actually depreciated for 4 years based on what's referred to as the half-year convention. So this $102,000 can be depreciated in a number of ways. You can just calculate, take the value and multiply it by the basis, and that certainly is an easy way to do that. But we also have a worksheet. If you use the capital budgeting cash flow worksheet, you can calculate what's referred to as the depreciation schedule. So here we put in the cost of $90,000, $1,200 is the installation cost, which means then that it has a 5-year maker's life, right? So if you put that in here, if we look to the right here, it's a 5-year asset, and here is the depreciation expense each year for this asset's life. So in year 1, you'll depreciate it $20,400. In year 6, you'll depreciate this asset $5,100. So let's think about this asset and how we can do this, right? And in fact, I'm going to skip example 2. I'm going to go right, we'll do that in class. So if you want to develop a statement of cash flows, then we need to understand the 3 series of cash flows that are involved in this calculation, right? So the firm's cash flows fall into 3 categories. Operating cash flows come directly from the sale and production of the firm's products and services. Investment cash flows are associated with buying and selling assets and potentially investments of the company. Now, financing cash flows, that's what results from debt and equity financing transactions. Now, it could be positive or negative, but obviously this is the financing question, right? How does the money ultimately go from the company to or from its investors? So our first line item, we have cash flow from operations. In this case, this company produced $780 in cash flow from its business. Here's net income, right? Now we've had some increases and decreases of line items that ultimately gets us to this $780. Now I'm not ultimately that concerned with us understanding how to create this statement. That is an accounting responsibility. But we do understand what the numbers are telling us. Cash flow from investment is a negative $300 because we bought plant and equipment, right? We didn't sell more than we bought, so it's a negative number. Cash flow from financing, changes in interest payments, right? We also have dividends that were paid. So in this case, we ultimately had $20 came in from from financing. So we had 780 plus 220, that's $800 came in the door, $300 went out the door. So the net increase in cash and marketable securities is $500. So essentially it says if you look at your checkbook, essentially, there should be $500 more there now than there was at the beginning of the year. So the firm's operating cash flow can be calculated a little bit simpler. It's EBIT times 1 minus the tax rate of the company plus the depreciation or all of the non-cash expenses. This acronym here is a little bit harder. Not too many people use this acronym, right? NOPAT, right? It's net operating profit after taxes. That's EBIT times 1 minus T. So the inside out company has $350,000 in EBIT. It has a tax rate of 20%, and this year's depreciation was $45,000. So what was the operating cash flow of the company? Well, so you have 350,000 times 1 minus T, right? So 80% of 350,000 plus 45,000. So 80% is $280,000 plus 45,000. So the operating cash flow for this company is $325,000. So we can conclude, right, that at least this number is positive, right? Positive is obviously from operations is a critical requirement, right? You have to make money from doing the business that you're doing. So now let's talk about free cash flow, because it is a little bit of it's for investors, it's a more important number, if you will. So free cash flow is the amount of cash flow available to investors. So who are the investors? Investors are both creditors and owners. Now this is money that's left over. It's available for them after we've taken into account everything else we want to do. So we've bought all the plant and equipment that we want. There's nothing else that we want to buy. We've adjusted our working capital, our current assets and current liabilities. So from business, from running the company, buying the assets that we want to buy, and managing the cash flow of the company, right? The current assets. This is money that's left over. What can we do with free cash flow? Right? We could use this to pay dividends, to pay interest, to buy back stock. We could use this to buy back debt, right? So all of those things are possible. So free cash flow is the operating cash flow minus all of the fixed asset investment. Notice it says net, so that could be plus or minus. Net current asset management, right? So that's net change in current assets minus the net change in current liabilities, right? So that could be positive or negative. So these numbers in the end basically give us a picture of how much money is left for the company, or for the investors, excuse me. So again, using this company, right? They had an increase in short-term assets of 50,000 and a decrease in short-term liabilities of 20,000. So what is the change in current assets? 50,000 minus 20. So NCAI, the net change in current asset investment, is $30,000. They also increased their gross plant and equipment by $125,000. So we need to calculate the following, right? What is the net fixed asset investment? It's that 125 plus the depreciation for that asset. So it's 125,000 plus the 45,000. So the net fixed asset investment is $170,000. So what is the free cash flow of the company? The operating cash flow was 325. 170,000 was the increase in fixed assets, and 30,000 was the increase in current assets. So we end up with $125,000 is the free cash flow of the company. So this company has generated more cash this year than they really needed. There is a spreadsheet or worksheet that you can use for this, where you can incorporate or talk about this whole process of buying and selling assets, right? So this is what's referred to, this is the capital budgeting worksheet, where you can input, so there's a new asset that you're going to buy, and you're going to sell an old asset. So we can incorporate this cost when we're talking about the ultimate cash flows of the company, because it's more sometimes than just buying an asset. There is buying an asset and selling an asset, and they both will create cash flows. So we'll talk about this in some later examples. So the final discussion is a little bit about cash budgets, right? We need to have a mechanism to forecast the short-term cash needs for a company. So if you could imagine, Friday afternoon, you're sitting down, you're writing checks for your payroll for your employees. You have 5 employee checks to write, and you look at your checkbook, and now you have no money left. You didn't plan very well. What are you going to do for those employees that are now not going to get a check? So really, the whole process here is a process of managing and predicting how cash flows flow outside the company. So we'll base this off of sales, but we also now need to have an understanding of what happens in production, what happens in inventory, what happens in accounts receivable. How do those variables change with respect to developing a forecast of short-term cash needs? So here we have this company developing a cash budget for October, November, December. The sales in August and September were 100,000 and 200,000. Sales are predicted moving forward of 400, 300, 200. Historically, 20% of the firm's sales have been for cash, 50% come in the first 30 days, and the remaining 30% after 2 months. Bad debt expenses have been negligible, and they're going to receive a $30,000 dividend from stock in a subsidiary. So basically, we have now calculated the cash inflows for this company. So in this worksheet, right, it's the cash budget worksheet. If you look across, here are our sales figures, and down here we have our forecasting ratios. If you remember, 20% were cash sales, 50% came in 1 month later, and 30% came in 2 months later. So the first month, right, which was actually up here, was August. We had $100,000. This coming month, next month, we're actually going to expect to get $30,000 of that. 30% of 100 comes here. 50% of 200 comes here, and this is 20% of this current month. So this month, or excuse me, next month, we expect $210,000 in cash receipts. Then 320. Now we also predicted we'd get $30,000 in dividends on month 5 here. So now we can calculate. We know what we expect moving forward, M3 through M6 for the next several months. We have an idea of what our cash inflow will be. What will the cash disbursements look like? Well, now we have to look at purchases. 70% of our purchases is what purchases are 70% of sales. 10% are paid immediately, and 70% is paid the month following, and 20% the month following that. So again, we have the same basic structure of cash flows being spent, but we also have to incorporate other expenses, rent, wages, taxes, etc. So we know what those numbers typically are. And again, we will get us for this, it's this year here, the next 3 months of the 3 months we're predicting. So next month, we expect $213 to go out in cash. So if we combine these things together, here's cash receipts, cash disbursements. Next month, we expect to have $3 less than what we started with. We're going to have $3 less come in the door than went out the door. What was our beginning cash? We started with $50, so we'll end up with $47. Our minimum cash balance we need, that's very important. That number here is $25. So is this going to require some financing? Right? So the required financing here is we need $22 to cover our expenses for the month. So it's positive. So we have $22 more than what we needed for the month. So that means we're going to take $22 and put it in marketable securities. It's going to sit there for a while. If this number turns negative, it implies we need to get money for financing that month. So in the second month, you've noticed we're $98 short. We started with $47, but that means we have negative $51 in ending cash. But our minimum cash, we know we have that stored aside, was $25. So that means we actually need $76 from financing. The $76 is going to cover this ending cash balance. We need to get this number to zero, but we also have to make sure we maintain our $25 cash minimum balance. So again, the idea here is to find months in the year where cash could become a little slow. And since we know that much of our annual business is cyclical, there will be months that require some short-term financing. We need to think about that ahead of time. So the cash budget just gives us a picture, if you will, of whether we expect shortages or deficits. Obviously, it's critical because we need to have arrangements, right? We need to have a line of credit or some other source to kick in there to be a short-term cover when cash flows are needed. And it's not that this is bad, it is a function of the way the business works throughout the month. So again, one way to cope with this uncertainty is maybe let's create several different cash budgets, right? Let's create a pessimistic budget, a most likely an optimistic, and then from that range, that will give us an idea of, in the worst case scenario, how much do I need to finance, right? In the best case scenario, what's the amount that needs to be financed? And from that, we might be able to get some longer strategies, if you will, to make sure that we get financing pieces in place. So that is our last video on cash flows and financial planning.